right, guys, are landlords in trouble? We are seeing tenants burdened with more than 30% of their salary now going to rents. And guys, there's a big disconnect of affordability across America. Today, I'm bringing you Matt, the Lumberjack landlord, and you're going to appreciate his perspective on how landlords and tenants should interact, their relationship together. So I hope you enjoy this show. Hey, Matthew, welcome to our show, man. Tell everybody a little about who you are.
So my name is Matt. I'm a Lumberjack landlord of 135 units, 47 buildings, built my business over 22 years. So invested in the Great Recession and, looking forward to seeing what new opportunities this market will create and how to manage and really kind of capital preservation is now the message.
So Matt, can you tell us what markets do you serve? Are you Northeast? I mean, where are you?
Sure. So I'm Northeast. So I'm in the state of New Hampshire. And I really focus on 3 towns in New Hampshire with a total population of about 50,000 people. So okay. We're not doing the big metropolises. We're doing the, mid-size cities and towns.
That's a lot of units, man. I mean, do you manage them all yourself?
I do. Wow. Yeah. Hence the Lumberjack landlord. I do manage them all myself with my wife. Wow.
So can you kind of tell the audience, I mean, what are the sort of like the price points? Would you say you're, serving more of the, middle income bracket, lower income bracket? Who do you serve?
Yes. About $1,000 or about $900 is our lowest unit. And then our highest unit is $3,500 is our highest unit.
So, I mean, for somebody that doesn't know your market, is that sort of like a middle range rental?
Yeah, so that is what we would call C's and B's. It's not A's. We do a little bit with single family, but the challenging thing with single family in the state of New Hampshire is that taxes are reassessed every year because we don't have an income tax. So the government makes up for it with high property taxes. And so single families largely don't cash flow. And so we kind of joke around about how, I own a single family and it doesn't cash flow. So in almost every case you'll find my portfolio is made up, those 47 buildings, it has one single family in it. And that was a unique situation.
Interesting.
So, yeah.
So, when you're looking at these buildings, I mean, are they kind of laid out like a house with 2 or 3 units, or are they more apartment style?
They're more house style. So old New Englanders, old Victorians, where you can get a lot of character. And when I see character, I mean all the nice, finial wood pieces that are a fortune to fix and paint. But yeah, a lot of that type of asset in our market. So when somebody in most markets is talking about working on an older home, they're talking about something in the 50s and 60s. When we say we're working on an older home, we're talking about something from the 1860s. Mm-hmm. So a lot of our stuff is typically between 100 and 140 years old is the stuff that we're typically buying and working on.
So these weren't built as multifamily, were they? I mean, were they just big single family houses that through the years have been converted?
Some were, some weren't. So some of the stuff that was built, in the 20s and 30s or in preparation of that, it was much like, a lot of those spaces were a lot smaller. People didn't need these big opulent spaces. It was kind of a smaller space. Often what you'd find in the wealthier parts of the city, things that were along the main streets and such, horse and buggy, a lot of that stuff would just be these massive mansions. A lot of those still exist, 4,000, 5,000 square feet. And if you think about when they were built in the day, that's absolutely massive. And so what we've seen a conversion of some of those buildings, but there were a number of them that were also kind of built that way, basically side by side with tandem kitchens and such.
Yeah, that's cool, man. Out of, everyone I interview and kind of, a lot of the comments that we get and a lot of the statistics that we show, the Northeast is kind of like its own microcosm. It's like, I get comments, we're talking about the market crashing and prices falling and things like that. And it seems like everybody from the Northeast says not here. We're not seeing it. We're not seeing declining house prices. We're not seeing declining rents. Kind of tell us, I mean, obviously shelter inflation, as you know, I mean, you're a smart guy. You're well invested in real estate. We all know that JPAL has, we know that the economy at large, I mean, we've seen nothing but record breaking inflation, and shelter inflation, the actual housing inflation, is probably one of the biggest drivers that has, made life unaffordable. I mean, we're talking about, rising rents, rising house prices, and really rising housing GDP in general, right? If you need to get anything fixed, you need to buy anything. And we've had supply issues. And, I'm going to take us back to like 2020 when the beginning of the pandemic, and, people weren't able to pay their rents. A lot of them were on unemployment. They were laid off at their jobs. What have you experienced personally as a landlord of a pretty decent sized business? Did you have any difficulty at all?
So we had 98% pay through rate during the pandemic. So we were pretty healthy.
Wow.
We were in front of it. I think in the end of February, we actually sent out a letter to everybody saying, we expect that the economy is going to deteriorate. We expect that there's going to be some issues. And so if you find yourself in one of those issues, please reach out to us. We'd be happy to try and work with you. I think we're kind of elite landlords. We've been doing this for over 20 years. We have at that time, we'd only had 7 evictions in those 20 years at the time. So we'd only had 7 evictions ever. And so we run a really clean book. We really appreciate our tenants, and we want to make sure that they were okay. That's the first and foremost concern. Our tenants are people. And they're people that we have a relationship with. And so only 2 people were not able to pay. We worked with them to help them with programs and such. And then as things rolled on, we didn't see it getting a whole lot worse. But what we did was we started reaching out to the different agencies saying, hey, if we have a unit come available, is that something that you guys would like to get? And so we kind of were on overdrive trying to get through units that we might have acquired. I've done 20 deals in the last 18 months. And so pretty heavy. So we didn't really see that. We didn't really see that degradation there at that point. We only had a couple people not paying.
So do you have a high, competition of investors in your area? I mean, when you're seeing that these houses and you're buying, 18 more houses through the last 2 years, would you say that you've overpaid for these properties?
I think my competition thinks that, but I won't show them my math. The fact of the matter is that if we engage and we close on a deal, our net income is 20% at a minimum. We won't touch a deal unless it's 20%. That's our basement.
Why isn't your competition seeing it that way?
I think that they didn't understand rents. They didn't understand the elasticity of rents. I think that it's the Warren Buffett saying where, watch where the water pulls out, you see everybody's swimming naked. I think that a lot of them didn't really understand. I think that there were some bigger guys that don't really focus. That's always been my aim, is to focus where the smaller investor focuses, because I'd rather be a big fish in a small pond than a small fish in a big pond. So the bigger investors, they're not buying duplex, tris, and quads. They're buying 10 units, 12 units, 20 units, and they're looking at cap rates and things like that, which are a complete different calculation over how I account for return on my capital. If I put $100,000 in a deal, I want to make $20,000 a year on that $100,000. So I just look at it differently. So I think that fishing where the big fish aren't, it makes me the bigger fish because I'm one of the larger 2, 3, 4 unit guys in my market. And we could put deals under pretty quickly because we know how to speak to sellers. We have a reverse offer strategy that was really a winning strategy for us through the entire 2 years, which was really talking to sellers and saying, what are the top 3 things that you want? And they would be like, you're just not throwing a price at us? No, I'm not throwing a price at you. What are the top 3 things that you want? Do you want to stay 60 days, 90 days? Do you want to wait until you find a place? Do you need dumpsters? Like, we were very creative. And so most of our deals, we weren't even the top bid. I think our best deal yet, we were the number 9 in price, and we still got the deal because they felt the most comfortable about our ability to close and that we were giving them all the concessions that they asked for.
Yeah. So these houses that you're talking about, these are single family houses that you're converting?
Nope, they're dupes, tries, and quads.
So who were the sellers? Were they other investors as well?
Nope, it was mostly people that had house hacked. It was mostly people that had lived in a unit and wanted to finally sell because they had gone through some pain in the pandemic. It was some investors that just said, you know what, with prices being where they are, and it's all relative. I did a show on my channel this last week where I showed people they were completely wrong about pricing. The price of the house doesn't matter. What really matters is your payment. Everybody buys based on payment. When the bank denies you, they're not denying you because the house was $500K or $800K. They're denying you based on your income versus what you can afford for a payment. So when we looked at it that way, we were always taking into account what rates were. I bought deals at 3.75 interest rate as an investor.
It's crazy. I mean, were they through the Freddie Mac program, the investor program?
I'm too big. So when you hit your 10 units, when you hit your 10 mortgages, right, Fannie and Freddie basically say no more mortgages for you.
Have you used that? Have you used your 10 mortgages with them?
Yeah, I did that. I did that years and years ago. We had gotten to our 10 mortgages. And so then after that, the only option is commercial debt. But now one of the newer options is DSCR loan debt, or you can do, where you're not actually having to worry about all of the conventional banking things. What they're really looking at is the asset itself and the income on the asset itself.
And your experience.
Yeah, absolutely. And the experience that you have. So, but those DSCR loans, those are available to almost everybody. I know new investors, even with 1 and 2 units or buildings, that are, small multis, they've gotten DSCR loans. So are they adjustable rate, or are they locked in for a period of time? Are they 20-year or 30-year loans? 30-year fixed. Yep.
Yeah, I mean, that's the way to go. I mean, if you guys are listening, I mean, what Matt's talking about here, I mean, if you're an investor or wanting to get into this, I mean, where I see investors get crushed is where they really go with these balloon type loans. I've done them myself. I'm in a couple of them myself, but you have to decide, if you're not able to pay them off or refinance. I mean, now interest rates are through the roof. Now all of a sudden your affordability goes upside down. You can be in the negative. So that's awesome, man. I mean, that's great. Sounds like you found a real niche. Matt, some of the issues that we have here locally, and I don't know whether this applies to you where you are, but we have very strict zoning laws here in Baltimore. So we can't, we see so much. I get investors all the time. They say, hey, Todd, I see this 2-unit or 3-unit. The problem is most of these are illegal. They're not a legal 2 or 3 unit. And people just go in, they make these accessory dwellings or whatever. They make an in-laws suite or whatever. And now they're renting it to 2 different tenants or 3 different apartments. And the problem is, what a lot of people don't know is that here in Maryland, at least what my experience in Baltimore County, Baltimore City, is that licensing and zoning are 2 different things, right? So you can have licenses. So you can buy a 3-unit that has 3 rental licenses, and it's an illegal 3-unit. And if zoning finds out about it, they're going to violate you and you're going to have to do something about it. And you can't always get the right to have those apartments. Do you guys have that same type of ordinance or, zoning law where you are, or are they much more lenient in allowing, multifamily in a single family house?
So we have it. We don't go through a licensing process the way that they do it here. So we have it, but it's just done differently. So the way that they do it here is you have X number of units of allowed in a building. And that's what the tax card says. And that's what the city says. You can go to try to get a variance or add an additional unit. That's a pretty challenging thing to do because in order to approve or get a variance approved, you actually have to prove hardship. It's really hard to prove hardship. So what you really are looking for is, if you want affordability to come in, the cities and states need to be looking at it and saying, hey, you know what? So long as it's done to safety standards, add another unit because we need as many units as we can possibly get. But it is a challenging thing here. We're starting to see towns that are approving auxiliary dwelling units or granny flats or au pair suites and things like that. You start to see a lot more approval of that type of stuff because they need to add units.
Yeah.
And in the Northeast, much like it is in a lot of where you are, there's not a lot of land available close to these metros. So they have to find a way to maximize that land. So they're approving some of that stuff. However, it's extremely expensive. It's $9,000 to $10,000 for survey plans and for meeting with the attorney and getting it in front of the town. Even if you get it approved, it's a $15,000 impact fee, and then it's a $9,000 sewer connection fee. And so before you've moved one 2x4, you're $35,000, $40,000, maybe even $50,000 into the project, and you could get denied, but you're spending that much money to see if you can get something like that approved.
Yeah. So do you think, with everything that's going on in the economy, do you think a lot of landlords, I had a recent podcast, Matt, where I had, Hemlane, one of the founders of Hemlane, Dana Dunford, on, and I was amazed. She said there's like 44 million rental properties, houses in America, rental units. That's a huge number to me. I didn't think it was that much, but whatever she said, 70% or whatever, it was a big number, are small operators, mom and pop landlords. With the environment that we're in and the economy, do you think that some of these landlords are going to be in trouble?
I think that there are investors that are going to be in trouble. I think that operators won't be in trouble. And there's a differentiation. I'm an operator. I'm not just an investor. And so I know how to run my business. I know that I need healthy margins. I know that we need to be over communicative with our tenants. I know that we need to give them a heads up. I'm not always looking for the last dime that I can get out of a unit. I rather have rental stability. So we have units that haven't been vacant in 10, 12, 15, 18 years since we bought them. And they've had multiple different tenants in them. But we have a level of, and how we do business and how we operate that ensure that we don't have vacancy. And so I think the challenging thing now is that when I post something on a Friday afternoon, by Friday night or Saturday morning, I'll have 100 inquiries. And of those 100 inquiries, maybe 15 to 17 hit our requirements. And then we get 3 or 4 from that are thrilled to be able to get a chance at the place. So the challenging thing for me is what I'm seeing in my market is that there is a high level of resilience. What most people don't understand is that in the Great Recession, rents didn't go down, they went up. As people lose their homes, those families don't go homeless. Those families find a place that actually meets their budget, and they then become competition in the rental market. So we haven't really, and they're not sitting there saying, I have to still have a 4-bedroom, 2-bath house. They're willing to say, hey, listen, we're losing our house over here. We just need a place to live. So we're willing to live in a 3-bedroom or a 2-bedroom, so long as it's, nice and clean and safe. They're doing what they have to do. So I think that there are going to be landlords or investors that are in trouble, but largely it's because in the last 2 or 3 years, everybody's looked pretty smart. Everybody's not that smart. So I think we'll start to see things change. And when we start to see that change, I believe that there's going to be a 10 to 20% correction in the market. I think rents largely don't go down. I think they're flat.
Do you think the 10 to 20% correction is not only going to be in the housing prices for sale, not the rental prices?
Yeah, because I think that we're going to see a 50% decline in transactions. I think we're going to be sub 4 million transactions at a run rate for quite some time. We're not going to be in the high 6s, low 7s. We're going to be sub 4. I think that on the pricing, I think depending on the market, I think nationally, I think we're going to see a 10 to 20% correction over the next, call it 6 to 24 months. And then I think on the rental side of things, the challenge that you have is in those corrections, rents don't go down. They just don't. That's factually speaking. In the Great Recession, they went up. In recessions, rents go up because people lose their homes or need to downsize. So I think largely what ends up happening is I think rents probably stabilize. We're not going to see a 20 or 30% increase in rents next year. I think the people that are in trouble are the large multifamilies that figured that into their pro forma and said, here's what we're going to see. We're going to see a 5 to 9% raise in rents for the next 5 years. They're going to get crushed.
Yeah, I think, and you're right. I think to your point, and guys, when he's talking about the Great Recession, he's talking about the 2008 era where, I mean, housing really tanked, and it was noted as the Great Recession. But I think you're right on the multifamilies. I mean, what we're seeing, was a trend that everybody had to live lavishly. And, there is a big disconnect. And some people say, well, people still want to live lavishly. Well, that's great, but they're going to want to pay less for it. So
Sure.
A lot of these operators were overpaying for these apartment complexes. I mean, lowest cap rates, I think, in history, right? I mean, I can remember when everybody wanted 10% cap rates, and then that got ridiculous, and it was more like 8 or 7. I've been in this game for a very long time.
Sure.
And, and then now all of a sudden we were seeing people taking 3 and 4, and, they were saying, hey, look, we're doing this on the basis of these are really C properties or D properties, and we're going to bring them up to be B properties, or, we're going to renovate them, revitalize them, and try and make them an A property by, adding things, amenities. And that's a tough market to compete in a recession and in a time where people are trying to pay their grocery bill, especially the young people. I mean, they're hit, I think, the hardest at this point because, a lot of them they're quite honestly, they're financing their groceries, right, on their credit cards. Yep. But I think, what you're saying makes sense. It's some good, sound knowledge that you've gained over the last 20 years. And by going through a couple cycles like myself, it takes being relational. It takes, understanding your tenants' needs, working with them, and making sure that you select the right tenant, because like they're bad landlords, they're bad tenants too. Sure. I guess the question that I have, is what about the institutional buyers that we hear that are on the sidelines right now, waiting for these house prices to dip 10, 20%, maybe more. I hear, certain builders are bundling their new houses. They're selling them to investors or to turn these communities into rentals and things like that. Kind of give some of your opinion on why, should somebody listening to this podcast, should they try and find a landlord like you? Should they try and find an institutional landlord? I mean, there's a difference. I would imagine you have an opinion on that. Can you just kind of expand on that?
Yeah, I think from our perspective, we work with our tenants, and so we don't do rent raises every year. We didn't raise rent through the pandemic. Duh. And other corporate organizations, they do it because it's a model for them. And so I think from my perspective is, I've seen people leave those corporate apartments and end up with a $3,000 and $4,000 and $5,000 bill, and they're a dog with a bone. They're not going to let go. So you better pay that. For us, it's kind of like we kind of are more on the side of normal wear and tear. You live your life there. We recognize that when you move out after 3 or 4 years, that we're going to have some touch-up paint to do. We're going to have some things like that to take care of. And so a lot of times we're really proud because we return a lot of our deposits. And so from my perspective, when I rented, which wasn't that long ago, when I rented, I always wanted to rent from a landlord that I knew who they were. I could pick up the phone, I could text them and say, hey, I've got this, that, or the other problem. And they're not, well, we're going to have to follow up with you. We might be able to be there in a week. And I think that becomes challenging. So I think if you want your best deal, you go with a small mom and pop. I think that the larger landlords, they're going to be in more trouble because they're going to have to raise rents based on their debt service being much more expensive. They're almost always in shorter term debt. And a lot of them, if you're in a building that's 5 years old, they likely bought that with a 5-year ARM or a 7-year ARM, which means that's an adjustable rate, which means that their rate could be going from 4 to 7, which means that that's a money loser. So I think the nice thing about mom and pop landlords is that they're much more about service. There certainly are bad ones, but they're much more about service. They're much more about relationship. And I think that they don't put as much pressure on the books every year of having to get some major rent increase. Yeah.
I think that's great advice. And you're right. I mean, Matt, what happens is as their costs go up, their rents go up exponentially. I mean, I know people that are saying that they were paying $1,700 at an apartment complex owned by, corporate America, basically, and their rates went up $400 or $500 in 1 year. I mean, that's crazy. It forces people to move. You know, man, I tell you what, you're doing a great job. It's awesome to have you on the show, guys. I hope that you cruise on over to Lumberjack Landlords YouTube and subscribe to his channel, guys, and shoot him a comment. He's doing a great job out there trying to help people in the Northeast. Matt, just before we go, man, maybe your 3 top best advice to someone wanting to be a landlord.
Yeah, I think if you want to be a landlord, don't be undercapitalized. Do everything that you can to make sure that when you're looking at that property, that you make sure that you're well capitalized, that you have funds, you have emergency funds. I think the second thing is, as you're studying the market that you want to be in, I'm an investor only in things that are close to me that I can go out and touch. You have to decide if you want to be a long distance investor, but the way to best decide that is to really understand one concept. What is the average rate of return on the assets that you're looking at? So if you're looking at a single family, do people normally make 6%, 8%, 10%? And whatever that is, whatever the average is, you want to do a great deal on top of that, which is adding 2 or 3 percentage points to that. And then lastly is, don't be impatient. You only need one. You're not buying 5. You're not the Rockefellers. You don't need to buy 100. You're buying one. So just make sure that your one is a great one.
And lastly, I guess just add to that, do you think they should self-manage or hire a management company?
I think it's different for everybody. Depends on family life and jobs and even personality. I think whatever you're doing, either way, you really need to run the numbers. And I would talk to some management firms in the beginning. Many management firms are going to charge you 8 or 9 or 10% if you only have one building. As you get bigger and they get more of that business, you can get down into the 5s and the 6s. But largely that rate's going to be pretty expensive in the beginning. So you just want to make sure that I always advocate on really trying to manage that yourself, the first one. And in fact, I have a strategy, the 4-3-2-1 house hack strategy. That's the strategy I'm encouraging most people to employ, because that's the one that gets you rich for sure, not get rich quick.
And I guess I can find that on your YouTube channel?
They certainly can. Yeah, just look up the 4-3-2-1 strategy. It's right there for you. Great video.
Well, thanks, Matt, for being on the show.
Appreciate it. Thanks so much, Todd.
And guys, if you like this video, you can let us know that you did by hitting that thumbs up. And as always, guys, we love it when you subscribe to Sachs Realty's channel. Hit that alert bell. You'll know every time we upload great content just like this. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.